Hi there, Brock VandenBerg, fund manager for TaliMar Income Fund. Today, I wanted to share my thoughts and ideas on a recent lunch I had with a prospective investor. Typically, obviously, people that are interested in investing in the fund will normally come into the office and provide me some insight into why it is that they're interested in investing in the fund. In a lot of cases, a lot of investors that are in our fund have invested or currently invest in individual trust deeds. Those not familiar with what a trust deed is, imagine a loan, and investors are essentially investing in or buying a piece of an individual loan. And then they earn interest from the income earned from the borrower making interest payments on that loan. Trust deeds have been around for the beginning of time and was actually a very common way of investing in this alternative investment source or platform. In fact, when I started my company, we were offering individual trust deeds where investors could either buy the entire loan or invest in a portion of the loan, and we would service that loan on behalf of the investor. But as we grew, as we were looking to scale, trying to put individual investors in every one of our loans became very complicated, very time consuming, and launching a mortgage fund in which we have multiple investors under a single umbrella became much more efficient for both us and also for our investors. And so I wanted to highlight what I explained to him as an investor, why a mortgage fund may be a better alternative. And some of the bullet points that I shared, number one is you're investing in a diversified portfolio of loans. So if you invest in a trust deed and that borrower stops making payments, your income generated from that trust deed stops. Now that compares with a mortgage fund where if one loan in the entire portfolio of loans stop paying, you are still earning income from the other loans. So it's not that 100% of your income stops paying. Number two was your ability to reinvest. So when you invest in an individual trust deed, you earn that income and that income is deposited back into your account, which for a lot of investors, that's just fine. But for a lot of investors in our fund, they may be investing in out of a retirement account, or these are funds that they don't need that income immediately. So they have the ability to reinvest those distributions. That reinvestment is added to the principal of their investment, and now they earn compounded interest. And so for a lot of investors, that is a benefit of investing in a fund over individual trust deeds. Now they can always adjust that if they decide, at some point in a fund that they want to take monthly distributions, they can always do that as well. Number three, and I think a lot of investors like this about investing in a fund, especially structured as a REIT, are the tax advantages. And the primary tax advantages if you're structured as a REIT, and if you qualify, you want to talk to your CPA about this, is that 20% QBI tax deduction. So essentially you are paying taxes on 80% of the income, your federal income tax on 80% of that income, not the full 100%, versus with individual trustees, you would not be able to earn that QBI tax deduction, or at least I don't know of a way that you could do that. The other great tax advantage of a mortgage fund is that if you are outside of the state of California, you're not subject to California state withholding tax. And again, that's because we as a fund are structured as a REIT, so you wouldn't be subject to that. Again, you could not get that tax treatment with individual trust deeds. And then the other point that I wanted to make is one of his concerns was that he had been investing in trustees for 15 plus years, and that the sheer number of trustees or the availability of trustees had seemed to decline, and the quality of the trustees had seemed to decline. And I can only attribute that to is the rise of more and more mortgage funds like ours, where we have access to typically higher quality trustees. We have access to higher quality borrowers, access to higher quality to capital markets and brokers, simply because we are a fund. And this borrower classification typically wants to work with a direct source of capital, number one, because they need to move quickly. alternatively as well is that these loans typically are larger in size. And so where we were in an individual trustee side, we'd be funding loans in the 500, maybe right around that range, because that's about as much money as we could aggregate per trustee. As a fund, we have the ability to fund much larger loans. So now our average loan size is around 1.2 million. But on a regular basis, we're funding loans in the 3 to 4 million range. And what I have found historically is you can get lower LTV loans at that loan size. There's less competition, so you can price those loans a little more at market. And then again, your borrower quality has a tendency, not always, but tendency to have more financials behind them, higher credit rating, just have a more sophistication. And so, that was the response that I received. What is about a mortgage fund that might, offer more benefits than individual trustees? If you're interested in learning more, if you have some comments about kind of what I discussed, I know people that invest only in trustees would have an alternative view of this, but I'd be interested in getting your feedback. Feel free to leave some comments down there. If you found this video interesting or educational, give it a like. Check out our content on our YouTube channel, TaliMar Financial. We post a lot of great content about this type of stuff. And I'll keep trying to post more content about my thoughts about the private lending industry and whatnot. Thanks for taking a moment to watch. Thank you.